Alrighty, what's going on, everyone? 10 a.m. on a Tuesday Eastern Time. We are doing some live financial modeling. Today is day one yesterday. Usually just a formatting day, pretty boring. Um, Today we're going to integrate all the income statements from start to finish. So income statement, balance sheet, cash flow statement. We're going to make all our references. We have the data we need in the monthly and annual detail, and we got all our assumptions set up, all the tabs. So we're going to go through and we're going to try and finish this entire thing today. So all the statements, we're going to do our sanity checks, um, make sure the cap table's working, the distributions, all of this stuff we're going to get into today. Before I do jump into this, let's look at smarthelping.com. The actual template that I'm updating is under the SaaS bundle. Number 3, ratio driven SaaS. This is the one we're upgrading right now. $125 one-time fee for this. Um, and keep in mind, there's all kinds of models and templates for different industries for HR departments, all kinds of stuff for employee tracking, HR tools for hiring and firing, scheduling, Gantt schedules, um, accounting tools. These are very popular. Cash conversion cycle, accounting ratios, volume discount pricing, inventory management, cost of goods sold, valuing, FIFO, logic, inventory reordering, all kinds of stuff here. And again, you can check out all the financial models at the financial models tab at the top. You can buy in bulk here. All the templates on the site for $9.99, a great deal. Or you can buy certain levels. Um, Color code key down here. So check it out. Don't forget to subscribe to the channel, and let's get into this video. So we have first things first, income statement. And in this model, we've got two revenue streams. We've got three different tiers of monthly recurring revenue from basic, standard, and premium tiers. And we also have one-time revenues, basic, standard, and premium, which is all driven by the assumptions tab here. This is driving total new customers, and then this is driving the pricing of those. So if we go to our income statement, we have one-time revenue, and then we have monthly subscription revenue. And this is just a simple revenue item. We link this here directly to total consolidated monthly recurring revenue. You can see this is just adding up all of this, which is adding up all of that. And it'll be adding these all up all the way through. Perfect. And one thing people get kind of confused on is they'll reference the previous month ending MRR in the next month, and you can't do that if you have pricing changes over time. Like this, so in year 2, your users are paying 440, but if you reference previous month, then on month 13, you're going to be referencing this when the starting amount should actually just be based on the total users in the new price. So you want to make sure that if you're doing this, you're not messing up the recurring revenue flow. All right, so we got one-time revenues, or wait, this is recurring. One-time revenues is here. Recurring subscription revenue would be here. And then there's not a third. We simply drag this over. So that's the first part of the income statement, is your receipts from customers. Then we have cost of goods sold. Let's look at that. So we've got like hosting, other costs we've got in here. I don't believe there's any other cost of goods sold. Nope. So that's there. We got gross margins. Now, operating expenses. Let's break this down. All right, so general and administrative. Let's see. I just summed them all up. However, to get a little bit of a granulation, we could just sum up. Let's see. This is all sales. Uh, we're going to have to just do it as one or two different items. Because if you change, I don't want to have, like, if you change some of the fixed expenses, it wouldn't flow right. So we'll just do um, OpEx and then startup costs. So this is your total OpEx. Then we do have startup costs will be here. Let's sum up this. Okay, we can drag this over. And I've got the model ending in November right now, and that's just to make sure the logic's working to stop operations on the end month. Interest, this should be fine. We're already referencing the debt schedule. Depreciation is all working off of this cap table, or not cap table, CapEx. And let's put in our validation for these. Just put them a couple apart, that's fine, just so you can see. So those amounts will all create depreciation expense. This flow in here properly till the end month, perfect. Our extraordinary income on the sale of business, that is based on terminal value and the remaining fixed asset book value, and there's some tax stuff there. That's all working fine. Let's see, global controls C6, and then C31 and 30. Okay, yep, taxes. Now, if you don't want to have taxes as part of this, there's a lot of reasons why you wouldn't. Um, you could just zero these out, but if you do want to see that, you'd put your tax rates in there, and there's one for capital gains, one for regular corporate income tax. All right, so this is good. The next thing we really need to do is update the annual, and then we're going to figure out make sure this matches. So 59. So this, some of this should equal 59 here. Yep. Okay. So there you go. That's the income statement. That's the easiest part. It always is the easiest one to do, in my opinion. Now if we move over to the cash flow statement, we'll get into this, and then we'll get into terminal value. Because that's the main thing we're going to have to update. So customer receipts should be pulling. So row 10. Yep. Revenues. OpEx looks good. See 25 and 15. So it's pulling this and cost of goods sold. Okay, yep. Payments for interest. Good. And then taxes. Okay, good. So you can see a lot right now. This business model is assuming you are only basically adding customers through activity by sales directors and account executives. So your revenues are going to be based on the count of those here, and that's why you see a lot of burn at first as you're hiring more people and you're building up the monthly recurring revenue. All right, CapEx is looking good. 685. 16825. 825. So that matches. All right, sale of the business. So let's do this. So terminal value D9. Got that here. 12-month trailing revenue. That's going to be, it is 10. Row 10 is the correct one. So it'd be this figure here. So one, yeah. So it should be pulling the last 12 months. So 3785. Oh wait, I did 10. 4,442,000,000. So if we go terminal value 4442, good. I'm just making sure it 4442. Then you get your multiple, so then the exit value is that. Sum applied to capex. Net sales from building proceeds is actually entered separately right here. Okay, let's go over here. It looks like we have good numbers. So this is just really high because we're ramping up um, based on these head counts. And I'm actually going to lower these back down. So this says you need for every one SDR you have, how many account executives? And it's not 25. It should be like maybe 2. And again, you can change these ratios over time to show improvement, for example, or show change in your strategy over time. So maybe over time, you want there to be um, more AEs compared to how many SDRs you have, or less. And then this just shows how many SDRs you're adding over time. This kind of drives the AEs, and the AE count will drive quota attainment and customer signups, and then that'll drive revenue. So what are we looking like now? Yeah, that's a bit different, 40 million. All right. And again, my numbers are all arbitrary. You'd go in and be putting your own numbers in, and this be your own model for your whatever strategy and market, and all these inputs will be specific to your situation. My job is to make sure that the logic works as you put in numbers here. All right, so terminal value is looking good on this end. Let's go debt, principal, make sure that's coming off on the end ones. Yep. Sale of stock. All right, so here's now where we have to go into the monthly detail to determine the minimum cash equity investment needed. And to do that, we have to add some other cash flow items that are not in this natively. So let's 69 to 89. Let's delete that. Okay. So formatting. So I've got some. We'll keep the advanced metrics just like they are. We don't need investor proceeds data. So we'll just have one. We'll just have one cash flow item. This is not relevant. So we can clear this. Clear this. All right. So we don't need this. We can change this to something else like CapEx. Exit value, we could split that. We could keep that both. So that'll just be the sum of these two cash flow items here, which is fine. So that'll be that CapEx. We need taxes. And then I believe everything else is already in here. All right, so let's go CapEx. Let's do taxes and exit value. These two. Now the minimum cash position we see on here is going to be what drives the equity, which then we could finish up the cash flow statement. Perfect. Alrighty, so let's go to the cash flow. We got a reference error here from what we removed earlier. Let's say, let's just redo the whole calculation. So we've got EBITDA, then we want to subtract out total debt service, add in debt proceeds, account for CapEx, taxes, and exit value. So there's that. We go in here, and the minimum cash balance that we see is going to be the equity required. So, okay, this looks good. Do the same calc on the annual. Let's also put in here. So we kept those the same. We just did 165, 66, 67. Now, if we check this number out, we should, this minus our monthly should equal 0 to make sure they're all using the same numbers. Perfect. All right, this is going real smooth so far. Now, we go to figure out our cash needed. It's going to be minimum of that, what we just calculated on 195. So let's get that in there. And that will mean our cash balance goes to 0, but never lower. If you do want to reserve, you can always put that into your startup cost table, like right here. And that means essentially when you get to 0, based on all the assumptions, you'll still have some left over. Right, so that's good. This all looks good. We'll do our tests in a bit. I need to finish more of the statements up though. Okay, so is our cap table pulling that figure? Yep, looks good. Date our dates here. Okay, so now balance sheet. This is usually the most difficult, but we should be pretty good. Yep, nice. Everything balances. So this is already pulling all the right data and references. And this is why it's so nice to have a template. And like I said, it's a little bit more work up front to get the formatting, get all the tab names matched. But now, when you're trying to make everything balance and doing this balance sheet and everything, it's a lot easier. I'm just basically checking to make sure it balances at the end, and it does. So that's okay. No, there is. So this should never be negative ever. So we are off by something. We'll have to figure that out. Go to the annual real quick. Yeah, so this should never be negative cash. So that's definitely a sign we've got an issue. We'll probably, all right, let's see, go to cash flow. Let's make sure we're summing these up right. So this this cash amount here. Ah, startup costs. We didn't subtract out startup costs, so minus this as well. Okay, now let's go back. There we go. And then we should see a zero balance here at some point. No, negative. Okay, we're still out by something, but that's a lot closer. Visuals all still seem to be intact. Oh, we'll update the monthly cash position. Let's just do that now before I forget. So monthly cash position. Okay, good. All the rest of this is good. What else could we be missing? So startup costs, subtracting out debt service, EBITDA, debt service, debt proceeds. $65, $66 should all be added. Yep, it is. It is 167 active value. Yep. All right, so let's go ahead and match this off with the cash flow statement and see where we're out. So our first month is this and this. Our February is 69. Okay, so here's where we can start to see if there's any variance. Okay, no variance. So it actually has to be something right in the beginning, because these are all exactly the same. Now my monthly, where's the min value? Let's see. 3920. Right here. So if I put in that here, this would be my zero cash position month, January 2023. Here we got some negatives, and yeah, so right there should be our zero month. But it's not, so we're missing something that's affecting cash flow. So here we're at 958. If we add in this, we're at 19. Yeah, that's about the difference too, almost exactly on that 1 month. So 950,000 even we're out. What could that be? 950. Nothing there. Oh wait, when's our start month here? January 2021. I don't think this would mess it up, but let's update these dates to the next year since we updated the launch year. I don't think this is what caused the issue, but it's good to just do this. All right, 950 even. What could that be? Well, let's see. So operations is basically 1.7 million in the hole. We're at 2 after adding the 1.5. 4. All right, 670. Where's my startup costs? Ah, okay. So there's the issue right there. Startup costs. So this goes to 189 and C22 on this. So we're missing, wait, 1.2. This is starting at C6. Ah, yep, I was missing that. Okay, okay. And we're going down to C22 still. 162. Now we're talking. Okay. So yeah, equity requirements up to 4.8 million now, which means that's what we're going to need from either investors and or owners to cover all the startup costs and expected burn to hire everybody and operate. So, balance sheet. This cash balance should go to 0. There it is. Okay, that's our nice check. So you can see this can actually be in balance, but still off if the monthly detail doesn't contain everything that's in the cash flow statement, which it needs to because it's all the same data just being represented in different statements. Okay, so that's great. That's balanced. This is balanced. Distributions. Okay, so here 194 is our row. Yep, 194. Checking if it's greater than 0 here. If it's less than 0 here. Remaining equity to use is going to be total equity plus anything in the initial debt proceeds minus startup cost here. Contributions. So this is just the total equity from all parties. Alrighty, and then this logic kind of flows through and shows what's available based on collecting all the cash up front. Do the percentages, which are here, which are based on the cap table. Initial contributions. So just we'll go right to the cap table here and do that for them. And for owners, it's just going to be this total. Whoop, this is row, column C, not E. All right, and that should match this. So project IRR is 77%. We'll give that a decimal. Investors is at 39.3. Owners at 375. And this is all going to be a function of how much equity you're giving away, how much contributions owners versus investors are giving, and essentially everything on this. All right, so distributions. Now this total, we can do a check against this minus our annual detail here. Oh, and I see there is an error. Hold on. This is off. 162. What are we out? 162. Ah, yes. So we had to update this formula as well in the annual detail. Okay, so that's good. Our distributions now lines up. That's good. So these are some sanity checks we're doing. So the model is assuming the total cash needed is all up front, and then any contributions, distributions after that, any contributions required, like these negative months here, will then be funded by any available equity that wasn't used in the initial startup costs. So the remaining equity to use is here, and it goes through, and then when that's negative, you then sum these up to get a net cash available for the period. And then that's what we're doing for distributions and discounted cash flow analysis, where you can see the net present value. And remember, the internal rate of return is just the rate that you can apply to future cash flows to make the net present value 0. So on this, if I were to put the internal rate of return here for the discount rate, this net present value would go to 0, as you can see there. So that's the relationship between internal rate of return, discounted cash flow. That's why internal rate of return is so important of a metric, because it takes into account timing. All right, that's good. Executive summary. So here we definitely have some updates. So CapEx is going to be pulling from this, and let's just pull all positive values in and then put the signs on the calc. Debt service is fine. We don't care about investor funding on here. Company funding, startup costs, yep, we don't want that. Loan payback we don't need. That's going to be in debt service. Proceeds from exit. That looks good. What are we missing? Taxes. Yep. All right. So let's make sure this is right. So we go EBITDA minus this, minus this, minus this, minus this, plus this, plus this. And then this total should equal what we've got in the annual detail here. Perfect. So that means we've accounted for everything. And what we want to make sure is the cash flow at the end of the cash or the balance sheet, this 64, is equal to this number after accounting for contributions from equity, which it looks like it is, but we'll do the formal sanity checks on the global control tab here in a minute. Distribution, so this looks fine. 77, 39, 374. Yep, this is our all linked up fine. Perfect. Okay, all that matches. Delete this. Make sure all the charts still look good. Perfect, perfect. These are the advanced metrics like customer acquisition cost, average customer lifetime value, months to pay back the CAC, LTV to CAC ratio. So all these are going to be based purely on your assumptions. These assumptions for revenue and these headcounts for growth and all that. Note, I did do for engineering, I made it as instead of manually inputting it on the fixed expenses here, we actually did it as a percentage of revenue drives, and based on a salary, we can define the headcounts for engineering. And again, those will be available. Let's see, I think I did. Yeah, headcounts by type. Number here you can see. And the beginning of these years are high because it's saying, let's go to customer service. So headcounts. So CS reps, we're saying how many you need per month based on monthly users added. So if we have a big added month, you're going to need a bunch versus how many you need for active users, which is going to be a smoother number. So these ratios here are going to drive the counts. And I believe we have head counts. Yep, here. And customer service reps. So there's engineering. Where is it? CAC, MRR, one-time revenue customer. I might have done on this matrix tab. Let's see. This is mostly for deals, but nope, it's not on here. Let me see. So where's this data at? Customer service reps. Ah, all the way up at the top. So customer service reps row 10. So you can see there, we got a big spike, 432, because in January 2023 we have what do we have 24. Well, it must be an assumption on, let's see. So year 3, 2456. Let's just make sure this is accurate. So then we want to do AC 66. So 66 is nothing. Divided by H, look at that, head counts. 23 plus AC 68 divided. So 25 plus 26. Right, okay. Let's pull up. So I got the original here. Let's make sure I didn't, because I could have changed something and not realized I messed up a reference. Let's just see. So year 3, I just want to see if this one has it too. No, so this one just looks normal. So I must have changed something. 23. Yep. Yep. So this was the original that I started working off of yesterday, and so I must have adjusted something because this should be referencing users added and ending users. So I'm glad I kept that so I could see this real quick. So this should be, we 1, 2, 3, 4, 5, 6, 7, 8, 9 users added. Whoop. Against ending users. Now, why is this ending user 0? We might have another reference error. Yep. How in the world did I get this all messed up? Oh, it must have been when I did the find and replace, and I replaced every C, not six or something, with or C5 to C6. So yeah, that's exactly what happened. Okay, that makes sense. So I need to look at column AC, and what's the other one that looked weird? March 2025. Yep, this one. So you see I just had to roll that over, roll this over. Okay. And actually we can just really try to make sure we get it here by taking all of these from here and just doing let's just, nothing should change. I can just drag these all the way over and get any potential issues that happen with that find and replace out of the way. Do the same thing here. All the way, well, we know that's right. We could do it all the way down to here. Oh, did that change anything? What was it, 40, 343? No, it didn't. Okay, so that's good. That's one thing where the visuals really helped us check something, which was an error for me doing a find and replace on those two beginning years because it had a C in it, and I did a find and replace on the formula. All right, so now that looks back to normal. Looks good. Okay, good, good, good. I'm just scrolling down and making sure there's no big abnormalities here. It will look a little different because we are going from one year to the next, which usually means assumptions change, so you're going to see some differences, but going from like 5 to 400 CS reps was not, that would have only made sense if the assumptions changed a lot between year 2 and 3, which they didn't, so that's why I knew there was an issue with the logic and it was a reference error. All right, we're looking good here. Looking real good. So we move to cap table. Let's see. So these are in error. So we got C9 distributions is probably a different one because I didn't import that. Yep, it's C10. So now I want to go to the cap table, update this reference to C10, and this is just showing, based on available distributions each period, how much is going to each entity based on their share of fully diluted ownership share in the company. So this gives you the IRR of each. Again, it's going to be based on how much each person contributed and how much equity they got as a result. And then 47.1 is a consolidated, which should match, yeah, 47.1. Now let's do the owners. So change this to 10. That's 379.9, 379.9. And then our checks are also off because this needs to be 10. C24 should be 25 for the owners. And then this should be 17, I think. Yep, 17. Okay, and that's just making sure a grand total the subtotals here on this equals the grand total on distributions, and that's another sanity check. All right, we are getting there, guys. We're getting there. Man, this is great. This is a good template, and now it's fully upgraded with all the new formatting conventions. We've got all the three-statement modeling done. Added a CapEx schedule with depreciation logic, which flows through to the income statement and everywhere else. And now we do sanity checks, and then we are actually done. All I really have to do after that is I'll make an overview video and update this index tab to explain each of the new tabs we added. All right, so let's do the sanity checks. So annual net income versus monthly. We know that's income statement H59, and that's a good. Next one is balance sheet monthly, so we're summing 60. Yep. And 60 on that one. So these two are good. Annual detail check against monthly, so let's see, J214. Oh, nope, that's J195. Update that. Annual detail, so here we want index, so this is indexing the cash balance on the end month minus annual detail. And this is going to be annual detail I-195 minus the total equity required, and that should be 0. It is. Executive summary. We'll have to do that. Oh, that we did it here actually, so that's just a new reference. Distributions. This is 10, not 9. Oh. And then minus that. Perfect. And then finally, distribution check N57, R59, which is checking, making sure these are all good. Yep. And the reason why it's nice to have these checks down here on the global controls, because oftentimes the things that will cause you errors are changing dates, terminal value, funding. So you can, and it's just a centralized place, so you don't have to go look at each individual tab. You can just come here and see if anything is off or looks off. And that should never be. Alrighty. Well, now we do our test, so we're going to try some different timing assumptions to make sure all this works. Let me check this real quick here. Another low day. Okay, let's make sure we're on the right one. Okay, so we're going to test the end month. Okay, we always want to see zeros here. Also check if we don't include terminal value, making sure everything's working. Let's look at, okay, yep, all that's zeroed out. Looking good. Okay, perfect. Put this back to yes. Now let's check partial month. And no, good. And let's check if we ended a year earlier. This is just me checking functionality of the model. Okay, still 0 checks. 0 checks. And finally, a partial year. That's not the last year. Looking good. You won't believe how hard this was to get right the first time. It turned out one of the biggest things was adding this logic to say, do you want to include terminal value or not on the end month? And if yes, it does. If not, no. That was really important to have. It made a lot of the balance sheet calculations a lot easier, as well as the CapEx stuff with the capital gains. Okay, looking good, looking good. Awesome. So here is the deal. Since I knew this was going to be a pretty quick one because it didn't have uh any nuance like the manufacturing plant definitely did, and the mobile home park one definitely did. So I now have time. Wednesday, Thursday, and Friday, I'm going to be able to go ahead and possibly do a new template. I tried to do so last week, or was it 2 weeks ago? I did basically a portfolio tracker for investment fund to manage up to 20 members. That was a cool one. And then before that, I did the volume price discount. So I'm gonna try to do another uh, next 3 days. I'll try to do um, something new, and we'll keep going. Next week, so this is ratio SaaS. Uh, Next week, what am I doing here? We're looking at so mobile home park ratio SaaS security monitoring service, and that should be another one that's pretty straightforward. The self-storage one I don't think I'll do because that's an equity only model and it's got all kinds of complexity. It's basically to do 6 different funds, showing an investor moving from fund to fund, and all it has complex joint venture waterfalls and all that. So this is not going to be integrated. No need to do that. And then we'll do automated kiosk, food truck, general rental. This will be a big one to do. That'll be a tough one, and we'll just keep going down until we finish all the startup models. All right, guys. I will see you on the next one. And again, don't forget to check out smarthelping.com for all your financial models. And there's stuff for startup models. There's also trackers for accounting, HR. There's joint venture waterfalls, real estate specific models like I showed you, self storage. There's also a mixed use model, value add flipping calculator, preferred equity and return, general waterfalls, cash flow waterfalls. There's more advanced waterfalls here in the joint venture section. And SaaS, this is again what we did today was upgrade number 3. And from these SaaS models, we've upgraded this one. We just did this one. Product as a service was done. Mobile app, general mobile app, freemium, lending as a service, marketplace, professional services. So we've done a lot of these. We still have to do ad network, um, security services, alarm services. I think that's what I said we're doing next, right? Yeah, security monitoring services. That's the next one we're doing next week is number 5. And then this is done today. And then enterprise SaaS will be a good one to do as well.